Example 8, alternative depreciation methods. You are analyzing three hypothetical companies or evenly, sooner, or AZ used. At the beginning of year 1, each company buys an identical piece of box manufacturing equipment for 2,300 and has the same assumptions about useful life, estimated residual value, and productive capacity. The annual production of each company is the same, but each company uses different method of depreciation. As disclosed in each company's notes to financial statement, each company's depreciation method, assumption, and production are as follows. So evenly uses straight line method, not surprisingly because of the name. Sooner uses double declining, again not surprising. And as used, so we are using unit of production method. Residual value is 100, estimated useful life 400. Now this information is for units of production method. So we have 800 boxes, 200 in year 1, 300 in year 4, in year 2, and 200 again in year 3 and 100 in year 4. So these are your productions. Now using the following template for each company, record its beginning and ending net book value, end of year accumulated depreciation, and annual depreciation expense for the box manufacturing equipment. So we are given the table, so we need to fill this up. Now for evenly, that follows straight line depreciation method. So the box is 2,300, residual value is 100, so we subtract residual value and we divide this by number of years, so we get $550. So each year $550 would be deducted from the box machine. So 2,300 is the beginning net book value, depreciation is 550. Again in year 1 accumulated depreciation would be 550 and net book value would be 1750, that is 2,300 minus 550, that gives you 1750. Now next year again we start with 1750 and we have the same depreciation because it's a straight line, so our cumulative depreciation is 1100. We subtract 550 from 1750 and what do we get? We get 1200. Next year we start with the book value of 1200, depreciation remains the same, accumulated depreciation 1100 plus 550, you get 1650. Now again 1200 minus 550 would give us 650. Now in the end we start with 650, again depreciation 550, total accumulated depreciation 2200, and we get the residual value of 100. The total accumulated depreciation is 2200. Now when we are using double declining, so we have 2300, this is our net book value at the beginning of box machine, multiply by 2. Now this is the formula because it is double declining, divided by number of years, that is your 4. So 2300 into 2 by 4 equals to 1150, or 2300 multiplied by 0.5 equals to 1150. So for the first year our depreciation is 1150. Accumulated depreciation again at the end of 1 year would be 1150, and net book value would be 2300 minus 1150. Now in over here when we are doing double declining, we need to be sure that in the end this 100 should come. This is the plug-in number because the residual value is 100. Anyhow, we start with the beginning value of 1150. So 1150, again we need to multiply this by 2 by 4, and what do we get? We get 575. This is our depreciation for the second year. We add 575 to 1150, we get accumulated depreciation, and the ending book value would be 1150 minus 575, we get 575. We start with 575, again multiply by 2 by 4 in order to get the depreciation, so we get approximately, we get 288. The exact number is 287.5, but we are rounding it up, so it's 288. We add 288 in order to find out accumulated depreciation. So 1725 plus 288 is 2013, and in the end 575 minus 288 would going to give us net ending net book value. So over here it's 287. Now we need to understand that even though the net book value is 287, we cannot do 287 multiplied by 2 by 4 in order to find out the depreciation. This would be wrong. Why? Because we know that the residual value is 100. So your depreciation for this year would be 187. So 287 minus 100, because this is what we know the ending book value would be. So the depreciation that we need to charge would be 187. We add 187 over here, and over here our accumulated depreciation is 2200. That is the same we got when we were using straight line. So in the end, accumulated depreciation doesn't change. Now this example, even though it has nothing to do with the overall explanation, so another common approach not required in this question is to use an accelerated method such as double declining for some period and then to change to the straight line method for the remaining. Now in this question we were using double declining in the first year, so as stated our depreciation would be 1150 and our net book value in the end would be 1150 as well. Now at the end of first year we start straight line method, so the net book value is 1150, our residual value is 100 and the remaining number of life is 3, so we get a depreciation amount of 350. Now from this term or year end of year 2, 3 and 4, this would be our depreciation because now we are using straight line. Now as used company uses unit of production method, so we have discussed this before, that first year it's 200, then it's 300, then again 200, and in the end we have 100. So we start with 2300. This is our beginning value minus the residual value, and now we need to understand that we subtract residual value in straight line and also in unit of production, but we don't subtract residual value in double declining. Multiply by the total amount of production can be 100. Now in the first year we have produced 200, so 2200 into 0.25 or 2200 into 200 divided by 800 would be 550. So this is our depreciation for the first year, and 2300 minus 550 we get 1750. This is our ending book value. Next year we again it's 2300 minus 100 into, we have produced 300 and the total amount is 800, so 2200 into 300 divided by 800 gives us 825. So second year depreciation is 825, so we add 550 and 825, we get 1375. That's your accumulated depreciation, and the net book value would be 1750 minus 825. That gives you 925. Third year again 2300 minus 100 into 200 divided by 800 will going to give us 550. So the depreciation over here is 550 and we add 550 to 1375, we get 1925, and 925 minus 550 we get 375. That is your ending book value. In the end we start with 2300 minus 100 multiply by 100 divided by 300, we get 275. This is our depreciation, and we add 275 to 1925, and again we end up with 2200. That is the depreciation, accumulated depreciation, and it is the same for straight line, double declining, and as well as unit of production method. And we are again left with the residual value of 100. Explain the significant differences in the timing of the recognition of the depreciation expense. Now, as we have seen in double declining, the depreciation that we have in the initial years, the depreciation is higher. So all three methods, despite the fact that all three methods result in the same total amount of accumulated depreciation over the life of the equipment, the significant differences are simply in the timing of the recognition of the depreciation expense. The straight line recognizes the expense evenly. The accelerated method recognizes most of the expense in the first year. And the unit of production, actually the depreciation depends on the production level. So if the production level is very high in the initial year, then the depreciation would be very high. And if the production level is low in the initial year, then the depreciation would be lower. So unit of production method recognizes the expense on the basis of production. Under all three methods, the ending net book value is 100, that is your residual value. Now part 3 states, for each company assumes that sales, earning before interest, tax, depreciation, and amortization, assets other than box manufacturing equipment are shown in the following table. Calculate total asset turnover. So we need to calculate total asset turnover, operating profit margin, operating return on asset for each company for each of the 4 years. Discuss the ratio comparing results within across companies. So we have given this that in year 4 the sale is 300,000, EBITDA is 36,000, and the carrying amount other than the box manufacturing equipment is 30,000. And over here it's a very important information given to us that including the box manufacturing, so total asset at the beginning of year 1 including the box manufacturing equipment at a value of 30,300. Assume that depreciation expense on assets other than a box manufacturing equipment totaled 1,000. Now these are the ratios that they have calculated. We need to find out how they have come up with the ratios. But first of all, total asset turnover is total revenue divided by average total assets. Operating profit margin is equal to EBIT divided by total revenue. EBIT means earning before interest and tax. Operating return on assets equals to EBIT divided by average total assets. So we need to come up with average total assets and EBIT in order to find out these ratios, because total revenue is already given to us. Now for evenly, we want to find out total asset turnover. So total asset turnover is revenue divided by average total assets. Now we need to understand that initially your total assets were 30,300. It is stated over here. And at the end of the first year, your assets would be, so we have 30,000 carrying amount of total assets excluding box manufacturing, so 30,000 plus 1750. This is for the box. This is the ending value of the box equipment. So our total assets would be the average between 30,300 and 30,000 plus 1750. So 30,300 plus 30,000 plus 1750 divided by 2 will going to give us average assets. And the revenue is 300,000. So 300,000 divided by 31025, that is the average of 30,000 and 30,1750, we get 9.67. Operating profit margin. Now operating profit margin, we have given EBITDA. EBITDA is 36,000. So we need to subtract 1,000. That is your depreciation other than box equipment. And we also need to subtract minus 550. That is the depreciation for box equipment. So 36,000 minus 1,000 minus 550. And the operating profit margin is EBIT divided by total sales. So total sales equals to 300,000. That is given over here. And we have operating profit margin of 11.48%. Operating return on asset. So operating return on asset is operating profit margin divided by average total assets. So we know that operating profit margin or EBIT is 36,000 minus 1,000 minus 550, that's equals to 34,450. So 34,450 divided by average total assets, that is equals to 31,025, and we get 111.04%. Now for the second year, the ending assets were 30,000 plus 1750. At the end of the second year, at the start of the year, it's 30,000 plus 1750, which is the end of the first year. At the end of the second year, assets would be 38,400 plus 1,200. And we need to come up with average of these two numbers. Total asset turnover is 320,000, that is your revenue, divided by 30,000 plus 1750 plus 38,400 plus 1,200. Sorry, it's not 38,400, it's 32,000. So it's 32,000. Your assets at the end of second year are 32,000. But this is excluding box equipment, so we add 1,200. So it's an average between 30,000 plus 1750 plus 32,000 plus 1,200 divided by 2. So we are calculating the average. So your revenue, that is 320,000 divided by 32,475, that's your average assets, equals to 9.85. Your EBIT would be 38,400 minus 1,000, that is your depreciation for the equipment other than box, minus 550. So 38,400 minus 1,000 minus 550 divided by your revenue, that is your 320,000, we get operating profit margin as 11.52. And operating return on asset, that is your EBIT, that is your 36,850 divided by average total assets, that is your 32,475, and we get 113.47. Now they haven't calculated for year 3, let's calculate for year 3. First we calculate the asset. So we have at the end of second year is 32,000 plus 1,200, and over here it would be 34,000 plus 650, that is the ending value. So average total asset would be 32,000 plus 1,200 plus 34,000 plus 650 divided by 2, that equals to 32,000 plus 1,200 plus 34,000 plus 650 divided by 2 is 33,925. That is your average assets. Your EBIT would be 40,800, subtract 1,000 and subtract 550. So 40,800 minus 1,000 minus 550 equals to 39,250. 39,250. Now our total asset turnover would be revenue, that is your 340,000, divided by average total asset, that is your 33,925, and we get 340 divided by 340,000 divided by 33,925, and that is 10.02. Again 340,000 divided by 33,925 is 10.02. Your operating profit margin would be EBIT, that is your 39,250 divided by your revenue, that is 340,000. That will be equal to 39,250 divided by 340,000. That is 11.54%. And in the end, it's operating return on asset. That will be EBIT 39,250 divided by your assets 33,925. 39,250 divided by 33,925 would be 115.7%. Let's check. The first one is 10.02, 11.54, and 115.5.7, and that is what we are getting. Now for sooner, the same mechanism would apply. So the first one is total asset turnover. So revenue remains the same, 300,000. So we need to find out your average assets. So firstly, if the beginning is 30,300, in the end it would be 30,000, and we also need to add the box. So 30,000 plus 1150, and we divide this by 2 in order to find out the average assets. So average assets equals to 30,725. So 300,000 divided by 3725 gives us 9.67. We need to find out EBIT. EBIT would be 36,000 minus 1,000. That is the depreciation for other assets excluding box, minus the depreciation for box, that is 1150. So 36,000 minus 1,000 minus 1150 will give us EBIT, and divided by revenue 300,000. So our operating profit margin is 11.28%. Operating return on asset is EBIT, that is your 33,850 divided by average total asset, that is your 30,725, and we get 110.17. Now for the second year, we know that at the end of the first year, the total assets were 30,000 plus 1150. At the end of the second year, total assets would be 32,000 plus ending value, that is your 575 for box equipment. So 30,000 plus 1150, that's the first part, plus 32,000 plus 575 divided by 2 because we are finding the average. And your revenue is 320,000. So 320,000 divided by 31,862.5, that is your average asset. That is going to give us 10.04. Your operating profit margin would be at the end of the second year would be minus 38,400 minus 1,000 minus what's the depreciation 575. So this is your EBIT, 38,400 minus 1000 minus 575 divided by 320,000 will give us 11.51. That is your operating profit margin. And your operating return on asset would be EBIT divided by total assets. So EBIT is 6,825 divided by 31,862.5. We're going to give us 115.57. Now for year 3, our average total asset first of all would be, so at the end of the second year, your assets are 32,000 plus 575. At the end of the third year, your assets would be 34,000 plus 287. And your average assets would be 33,431. Your average assets, your EBIT would be 40,800 minus 1,000. That is your other equipment minus the depreciation. That is your 288. EBIT would be 40,800 minus 1,000 minus 288 would be 39,512. So for your first ratio total asset turnover, it would be revenue, that is 340,000, divided by average asset, that is your 33,431, and we get 10.17 for your total asset turnover. For your operating profit margin, that is your EBIT 39,512 divided by revenue, that is 340,000. So 39,512 divided by 340,000, that will be 11.62%. And for your operating return on asset, that would be EBIT 39,512 divided by average assets, that is your 33,431, and this equals to 118 point, approximately 118%. And let's check. It's 10.17, 11.62, and 118 approximately percent. Now for your as used. Now again, at the beginning we have 30,300 as our assets that are given to us, and at the end of the first year our asset would be 30,000 plus 1750, and the average would be 30,300 plus 30,000 plus 1750 divided by 2. This gives us 31,025. Your revenue is 300,000. Revenue divided by average assets will going to give us total asset turnover. Your operating profit margin would be 36,000 minus 1,000 minus the first year depreciation is 550. So 36,000 minus 1,000 minus 550 equals to 34,450. Operating profit margin is EBIT divided by revenue. So revenue is again 300,000. You get 11.48%. Operating return on asset is EBIT divided by average total assets. So EBIT is 34,450 divided by average total asset is 31,025. So this is our operating return on asset. That is approximately 111%. Now year 2, we start with 30,000 plus 1750, and in the end our asset is 32,000 plus 925. So 30,000 plus 1750 plus 32,000 plus 925 divided by 2, because we are calculating the average, and we get 32,337.5 as your average asset. So total asset turnover would be revenue 320,000 divided by average asset, that gives us 9.9. And operating profit margin, we need to find out first EBIT. So EBIT would be 8,400 minus 1,000 minus your depreciation, that is your 825, and we get 36,575. So 38,400 minus 1,000 minus 825, and your revenue is again 320,000. So we get operating profit margin is 11.43. Return on asset is your EBIT divided by average total assets. So EBIT 36,575 divided by 32,337.5 as your average asset. That gives us 113, approximately 113%. Now for year 3, we need to first find out your average assets. So we start with 32,000 plus 925. and we end up with 34,000 plus 375. Your average assets would be 32,000 plus 925 plus 34,000 plus 375 divided by 2. So we get 33,650. So we add them up and divide this by 2. Your EBIT would be 40,800 minus 1,000 minus 550. This would be 33,650. Now for your total asset turnover, revenue, that is your 340,000, average asset, that is your 33,650. So 340,000 divided by 33,650 equals to 10.1. Your operating profit margin would be EBIT, that is your 39,250 divided by revenue, that is 340,000. 39,250 divided by 340,000, that is 11.54%. In the end, operating return on asset would be EBIT 39,250 divided by average asset, that is 33,650. So 39,250 divided by 33,650 multiplied by 100 gives you 116.64%. So this is your operating return on asset. And if we compare evenly, sooner, and as used, so if we compare evenly with sooner, now the profit margin in the first year is smaller and return on asset is also smaller than evenly. The reason being is because of higher depreciation. And in year two, the profit margin actually, as far as return on asset is concerned, it goes up because in the end of the second year, the depreciation in sooner would be lower. So depreciation in sooner is 575. It's still higher than 550, but as compared to 1150 initially, now it's lower. And as you can see, the return on asset of sooner actually starts to go up because the depreciation amount starts to go down. And also your profit margin is also increasing because again the depreciation is lower.